Now, sticking with the day since headlines, Investec has reported a strong performance in spite of a volatile operating environment, a performance the group calls a demonstration of the underlying strength of its differentiated client franchises. Group Finance Director Nishlan Samujh unpacks this performance in greater detail. Thank you so much for your time, Nishlan. Now, the first thing that jumped out at me in the results commentary is the highlighting of the volatile operating environment. Talk to me about what has been of most concern in the macroeconomic environment for the bank.
I think you know it. You can almost pick any day of the week, right? Let's just think about an interview yesterday and the sort of positioning that was in the White House and that playing out, the budget 3.0 just a couple of hours before that. And if we rewind to the beginning of our financial year, we were actually waiting for the election outcomes both in South Africa and in the UK, pre-GNU development. Post-June, July, you get into a whole new political environment, both in South Africa and the UK. And then obviously the tensions playing out when you get to the positioning and pretty much the US policy, particularly around tariffs. So when we talk about volatility, it's just been that type of environment.
Yeah, indeed. And I mean, even when operating under an economic environment filled with headwinds and uncertainty, Investec still managed to produce record pre-provision adjusted operating profit. What levers did you pull for this performance to build on your strategy wins?
So I think a few things. Number one is, at the right times, we remain cautious. We haven't just chased activity for the sake of growing books and for the sake of growth.
Yeah.
And at the same time, remained relatively close to our client base, understanding when you could become a lot more active, and at the end of the day, being a partner that is available when required. The second thing is also actively managing our balance sheet and ensuring that we optimize the cost of money, we optimize the yield that we earn in an environment of reducing interest rates, as well as, I think in these results, you would have seen both strong fee and commission income as well as investment income. So again, being quite active with our clients throughout the period.
Yeah, I'm going to come back to South Africa now, but just maybe a brief overview of the environment in the UK. I do note that you say that you dealt with the effects of deposit repricing, and also there is the £30 million provision, of course, that you had set aside in the previous financial year for the FCA Motor Finance Commission review. How's the business performed amid those factors?
Well, we're quite proud of the business. If you look at its positioning in that particular market, I think we're uniquely positioned. We're really deep into the market with relationships that we've built both with our private clients as well as our corporate clients, and staying close again in that environment. Now, to an extent that rates have started to reduce in probably at a slower rate than we all thought it would happen a year ago. It still has had the effect of bringing some opportunities in the market. And at the same time, fee income, really talking about the business being able to continue to grow its client base, to continue to grow its loan books. So when you see a loan book, for example, staying steady, to the extent that that book is repaying, it means you've got activity on the backdrop that is keeping it at the levels that it's at. So again, I think a great performance in a very toughish market.
Activity in the loan book, but still you're talking about those interest rates that are coming down slower than what we had anticipated. What's the level of credit impairments that you're experiencing at this point?
Well, we think that we'll continue to operate probably at the higher end of what we guide the market to. So our credit loss ratio in the UK was 60 basis points. Over the fullness of time, we think we operated between 35 and 55 basis points. And what we're really saying is, the impact of rates higher for longer does have a negative impact and also the uncertainties around tariffs and so forth. So we've really pointed to a cautious outlook in the near term, converging to the guidance that we provide as we move forward in time. All things equal, the environment is definitely better than it was last year. You've seen GDP growth come out at 0.7% in the first quarter, which I think has been a positive momentum. You've just seen a rate decrease of 25 basis points in early May. So we think, and the UK-US sort of environment appears to be a lot more stable with regard to negotiations and where that's heading to, as well as the UK-Europe relationship also moving into a lot more positive territory. So our clients are active throughout the UK and Europe, and we have businesses both in India and in the US. And I think all of these have, really held up strongly.
Yeah, and specifically on South Africa, I mean, even yesterday we got a GDP forecast that was revised lower to 1.4% for this year. What have been your anchors in South Africa, but also really where you are seeing the most opportunity in eking out further growth?
Yeah, I think South Africa, if you look back to the last 5 years, we've been in a low growth environment. And I think we've built the muscle to effectively operate in that environment, continuing to seek expansion in terms of market share, continuing to effectively evolve our product offering and find new avenues. This market still remains highly relevant for us as a business. We still have, whilst we are deep into the market, and have a strong brand altogether, there are many areas where we have low market share. So we think, being hard at the game and really being close to our client base gives us opportunities. So all said, if you're looking at GDP growth for the next year, I think it's still hard to calibrate exactly where that could be. But the reality is, things have moved forward. We do have Budget 3.0. We do have the intentions to spend more from an infrastructure perspective. And at the end of the day, we do have some stability, albeit we're not fully out of the woods with regard to the Eskom and the supply of electricity, and positive intent to improve infrastructure overall, including our rail networks. So we're moving in the right direction. It's just about pace.
Yeah. Well, talking about spending for growth with Investec, in terms of your capital allocation priorities, what do those look like in the short to medium term?
Well, at the end of the day, we've seen fairly muted growth in risk-weighted assets. Some of that is because we've been introducing more efficient measurement bases. So to the extent that activity picks up, you should see a natural increase in risk-weighted assets and therefore capital consumption into the base. But what we are very conscious of is ensuring that we continue to seek to provide returns greater than our cost of capital. So we've built in an intent to execute a level of buybacks of shares of around 2.5 billion rand. That's over and above the distribution levels that we maintain with regard to our dividend yield that we offer into the market.
All right. Well, thank you so much for your time, Nishlan. Really, really appreciate. Always a pleasure chatting to you. That was Nishlan Samujh, Group Finance Director at Investec.